This analysis examines CleanSpark's massive 102% revenue growth and its recent shift to profitability.
Right.
And it juxtaposes that against this recent 8.75% stock price decline.
Framing it as a growth paradox.
Yeah, and a potential buy the dip opportunity.
And that framework, that growth paradox, is a fantastic hook. You know, the title, Explosive Growth, Buy the Dip. It sets up the mystery perfectly.
It does.
But we have to talk about how that narrative tension is handled. Or rather, how it isn't.
That takes us right to our first high-level point. The analysis report establishes this really powerful central conflict, the growth paradox. But then it immediately resolves the tension.
It completely deflates it.
And that really lessens the persuasive force of the whole argument.
Exactly. You've given the recipient this incredibly dramatic situation. How can a company report, $1.12 in EPS?
When the forecast was only 28 cents. It just crushed it.
It absolutely crushed it. And yet, the stock is dipping to $13.72. That should create some serious tension. That's the whole essence of a market opportunity.
It should make you stop and think, wait, what am I missing here?
But the report doesn't let you do that.
No, the argument is that the fundamentals contradict the price dip, but the structure, it calls the dip a potential divergence. And then, right there in the summary, it just delivers the verdict. Buy the dip.
So you know the answer before you even understand the depths of the problem.
Right. The journey is over before it begins.
And that is the crucial weakness here. This choice, it sacrifices the drama you need to build real conviction.
But hold on. If the recipient is coming to this analysis for an actionable conclusion, aren't we just saving them time by giving them the bottom line right up front?
Well, that's the thing. We aren't just informing, we're trying to persuade.
Okay.
If you lead with the verdict, every section that follows, where you explain the massive EPS beat and the reasons for the price decline, it all just becomes defensive.
It's a justification for a conclusion you've already stated.
Exactly. But imagine if you did it the other way. If you lead by just hammering the fundamental strength, the 1.12 EPS, 4 times the forecast, that incredible $364.5 million swing to profitability.
You build up this picture of an unstoppable company.
And then you reveal the price dip. Suddenly, that dip looks completely irrational. It forces the recipient to lean in and urgently seek out your explanation for this disconnect.
So the suggestion is really to let the paradox breathe. Make the recipient feel how absurd the current price is, given the performance, before we offer them the way out.
Precisely. A concrete suggestion is to reframe the structure. Make Section 3, why is the stock down, and Section 4, the bull case, feel more like a structured debate.
So you're forcing them through the analytical process with you.
Yes. Rather than just giving them 2 lists of pros and cons, you want them to think, this stock drop makes 0 fundamental sense. There has to be some temporary reason that I need to understand.
Which means elevating the sheer shock of the fundamentals right at the very beginning.
Absolutely. Take that massive profitability swing from a loss last year to $364.5 million in net income. That needs to be the core of the opening paragraph.
You establish the strength so starkly
that when you later mention things like Bitcoin correlation or sector weakness, they feel like minor temporary headwinds, not like primary risks that need some huge rebuttal.
You could even, as a specific example, retitle a key section to something like the 1.12 EPS shock versus the 13.72 price disconnect.
That's a perfect way to do it. It aggressively links those key metrics to the market paradox right away. It creates urgency. It ensures the whole analysis is read with maximum engagement.
That's a really powerful way to tighten that narrative. Okay, so once we've established that conviction, we have to talk about the main thing that threatens it.
The central risk.
Which brings us straight to our next point.
That's right. We need to make sure the report structurally integrates the AI pivot to mitigate that sector risk.
Price, but its placement just kills the impact of this crucial factor.
Yeah, it correctly identifies that BTC volatility and the general sector weakness, shared with peers like Mara and Riot, are the main reasons for the stock dip.
And for most investors, that's the sticking point. That's the reason pure play miners get discounted.
It is, but then the strongest possible counterargument, CleanSpark's aggressive move into high-performance computing and AI data centers, is placed way down in the bull case section.
It's treated like a nice little bonus for the future.
Like an oh, by the way. Not like the immediate risk mitigation that it actually is.
So it feels like the report introduces the company's biggest vulnerability and then makes the recipient wade through paragraphs of other stuff before getting the one piece of information that truly differentiates it.
And if your goal is to convince someone that CLSK is fundamentally different from its peers, then that AI diversification isn't a secondary point. It is the most significant differentiating factor.
It's the whole story.
It could change its valuation multiple entirely. So that detail, it needs to be integrated right where the weakness is first identified. It should be the direct countermeasure.
Is there a risk, though, that if you push the AI story too hard, it makes the current, highly profitable Bitcoin mining operation look secondary, or maybe distracts from the core business strength?
Not if you frame it correctly. It's not about overshadowing the mining. It's about insulating it.
Okay.
By bringing that AI infrastructure story up front, you actually change how the asset is classified. You're basically arguing that CLSK shouldn't be valued just as a cyclical commodity play anymore.
But as a diversified tech infrastructure asset.
Exactly. One that gets the stability of data centers while still having that exponential upside from high-efficiency Bitcoin production.
So the suggestion is to preemptively hit that sector weakness argument with the diversification strategy, using the hard evidence.
Precisely. When you're discussing sector weakness and that dip it shares with its peers, you immediately introduce the AI pivot as the critical decoupling mechanism.
Maybe a dedicated subsection right there.
Decoupling factor, AI infrastructure. It completely reframes the risk profile right when the recipient is most worried about volatility.
And to make it credible, we have to use the specific, actionable data. The report mentions the company acquired 271 acres just for AI infrastructure.
That's gold. You have to use that. And not as a footnote. That 271-acre acquisition is conclusive evidence that the company is actively moving away from the pure-play miner model.
It's a capital commitment. It's not just talk.
It's real. And that detail needs to be put closer to the operational metrics, like the 587 Bitcoin they mined in November, to show this tangible, balanced future between current production and forward-looking strategy.
Integrating that AI strategy up front, it really transforms the whole analysis. It shifts the conversation from, is Bitcoin going up, to how soon is this diversification going to be priced into the stock's multiple?
Exactly. It shows the company isn't just trying to survive the crypto cycle, it's trying to transcend the very sector correlation that holds its peers back.
Okay, so that strategic reframing provides the fundamental conviction, but an actionable buy-the-dip call needs precision on the entry point.
It does. A strong thesis needs to link those deep fundamentals to a clear timing mechanism.
Which leads us to our third critical opportunity here.
Indeed. The fundamental case is strong, but the timing mechanism could be tighter, which is about bolstering the technical analysis for actionable conviction.
The technical analysis snapshot, as it stands, it's too brief. And it feels totally divorced from the strong fundamental arguments that come before it.
Right.
And that really weakens the conviction behind that final actionable takeaway.
The material does correctly identify the critical support range, $13.50 to $13.70. And it notes the bounce off that level. That's vital information.
It is.
But it just stops there. It doesn't explain why those technical levels should matter to an investor who was looking at a massive $25.57 analyst price target.
Which is like, what, 85% upside?
Around that, yeah. So right now, it reads like two separate reports, one fundamental, one technical, that just barely talk to each other.
When the whole point of technical analysis in a report like this isn't just to draw lines on a chart, it's to confirm the timing and help manage the risk of the entry.
That's it. The section needs to functionally link that technical floor to the fundamental valuation gap. It has to make the buy-the-dip recommendation feel calculated, not speculative.
The core issue seems to be that the technical floor is presented just as a historical price point. It doesn't have any financial gravity to it.
Right. We need to use the company's strong balance sheet to actually reinforce that technical support.
The report does note the company has substantial crypto holdings, about $1.2 billion, and a really efficient balance sheet. How do we make that connect direct to the 1370 support level for the recipient?
We tie the hard asset value directly to that psychological technical floor. You could phrase it something like this. The technical support near 1370 is psychologically reinforced by the company's highly efficient operations and its substantial $1.2 billion in crypto holdings.
Okay, I see.
This suggests a firm floor of fundamental bookable value, making a sustained breakdown unlikely.
That transforms $13.70 from just a line on a chart into a fundamentally reinforced entry zone. That's a huge difference.
It is.
So let's look at the upside then. Instead of just listing resistance levels at $15 and $17.50, we need to explain the consequence of breaking through them.
Absolutely. Technical breaches are acceleration points. If the fundamental conviction is tied to that 85% upside target of $25.57, then those resistance levels become the keys to unlocking that move.
So breaking 1750 isn't just a number, it's a catalyst.
It's the accelerator. You connect breaking that $1750 level to the potential for a rapid move toward that average analyst target. The technical hurdles become the pathway to reaching the fundamental destination.
And finally, managing risk. Any robust analysis needs a clear invalidation point. If the recommendation is buy the dip, you have to define the point where the analysis is wrong.
You have to. That detail has to be articulated clearly to make the recommendation truly actionable and credible. If that $13.50 support level is breached.
The thesis is challenged.
Yes. And you need to add that context. Something like, a sustained close below $13.50 would challenge the fundamental thesis, requiring an immediate reevaluation of the sector correlation risk.
And the whole AI decoupling strategy.
Exactly. Adding that clear exit plan makes the analysis robust, comprehensive, and it shows calculated risk management. It elevates the report's credibility in a big way.
Okay, that brings us to the close of our critique of this analysis report on CleanSpark's growth paradox. The core material here is very compelling.